In today's episode, we're looking at property investments in an outlier market, buying property cash versus using leverage, and then also looking at someone who earns offshore and whether they should be investing offshore. We've got some questions about that. Currency considerations. One important thing that I'm going to discuss in this episode is the single most important mindset shift that I want to instill in every person I meet, no matter how old they are or what their level of income is. So if you're wondering what that is, I'll definitely encourage you to listen and wait until the end. Okay, let's get started. So the wildlife guide, and he lives in Limpopo, which is the province in South Africa, where there is a lot of wildlife tourism. He says that, "Hey Carla, I saw the video that you made about stocks versus the small property investment in Cape Town." And he said, "Awesome, you make fantastic videos, thanks. But one of the problems I have with many of these analyses, including yours, is that they generally start from the basis of having to borrow money from the bank to buy the property and then paying it back. What if you buy the property cash, and how does that pan out? Granted, not many people have done this or do this, but he made his surveyed calculations and he wants to know whether that's a good investment. And he actually rents out 2 properties in this way. And he says, have we made a moorse mistake or not? Both properties are bought for under R1 million in the Limpopo province. They are rented out at an average of 7,000 Rand each after general expenses and body corporate fees, and one is new and the other not. The maintenance is 1% on the older property, 1% of the property value, which is usually the assumption I make in my videos. So, in short, he basically says the one property is rented out, and he gives me a value which I'll look at in detail, and also what the rental income is after expenses. And then the other one is a little bit unique because it's a second property that they built on their land. They've got a 2-hectare property that they live on, and they built another house there that they're renting out. So we'll also look at, because that's quite a different or unique situation, I'll also tell you how we can analyze that. The funny thing is that when I make videos about buying properties in cash, then people tell me, but who buys property in cash? Because usually people just put down a deposit, and the one big upside of investing in property or buying property is that you only need a small amount of money as a deposit, and you can get a lot of leverage from a bank. So everyone is always like encouraging me to know you should rather assume that leverage is being used, and leverage is really just a fancy way of saying you're borrowing money from the bank to increase your exposure to a certain asset, a property in this case. So and the thing is, when I use a leverage example, as in where money is borrowed against a property, so you're putting a 10% deposit down and you're borrowing 90% from the bank, then that's almost the best case scenario outcome in terms of returns, because you are only exposing 10% of your money, of your own money, and the other 90% you're borrowing, obviously at a cost, which will be your cost of debt or your lending cost, but you're generating the returns on the full amount of the property. So when the property grows, you get growth based on the 100% of the value, not only the 10% that you're exposed to, but I mean the 10% that you put your own money towards. So that's like a benefit of borrowing money from the bank. Unfortunately, it doesn't always work this way. Many times that I've seen, the property's returns actually don't even, they don't even make up, or the returns don't even exceed the cost of the loan from the bank. So in this way, you're actually, losing money, because it's costing you more to lend money from the bank than what the property is making you. We'll discuss this in detail and you'll know exactly what I mean. So the one big thing about buying a property in cash is that your opportunity cost is very big. Because if, let's say, a property costs R1 million and you're putting 100K down and you're borrowing 900, then your opportunity cost is only on the 100K that you're putting down, because you only have to think about what else could I have done with this 100K. If you're buying the whole property cash, you're putting a full million in and buying it cash, then the question becomes, what else could I have done with a full 1 million? So the opportunity cost consideration is massive. And this is always how I look at investments is, I'm doing this, but what could I have done with this money elsewhere? What other returns could I have earned in the stock market over the long term, for example? Yeah, it's really just a way to kind of set an easy benchmark for yourself to make some decisions is to compare it to what's a long-term average in the stock market returned over 10 or 20 years, if your timeline is long enough. Okay. The first one is a property that is rented out. The current value is 900,000 and it is rented out for 7,500 a month. And the expenses, according to him, is around 500 a month, like the rates and taxes and the levies. And he says that there is no maintenance cost yet because it's a new property, although that sounds a little bit low on the cost side to me. But let's go with that. So the net rental income after costs is 84,000 a year. The one problem is that this is taxable. So this full income, and this is one thing about property income, is that you can structure it, yes, you can structure it in a trust or in a company, but if you make profits, then it will be taxable. If you don't have any debt, then you don't have any interest that you can deduct as an expense, but debt is not always the answer, or leverage, as I explained before. So if you assume that that this is taxed at a 35% income tax bracket, I'm just assuming that they're holding this in their personal capacity and that the tax rate is 35%. I mean, if it's a company, the tax rate will be a little bit lower. If it's a trust, there will also be a tax rate applied to it. It's not, tax-free. So in this case, at the 35% tax bracket, that would be 29,000 of tax. And then after tax, rental income after tax would be 54,000. And that gives us a rental yield, which is looking at what returns do we get over the value of the property. So the yield on this value is 6%. And of course, properties return profiles have two components. They have the rental yield that you get, but also the capital growth that you get. And his capital growth, in this case, he said this place cost 750,000 in 2023, and now it costs now the value is 900,000. So that gives me a compounded annual growth rate. So an annual growth rate of 9.5%, which seems extremely high. And this is probably like some of the best properties in South Africa give this kind of annual growth. And the thing with this annual growth is that I don't know if this is sustainable, as in would this growth rate continue, or would it continue to grow at this rate in future? That's the one thing. The next thing that I would comment on this is that when you are in a market, in an area where he specifically made the comment that this is in Hoedspruit and there is like quite a crazy demand for property, is that when property values go up by so much because there is more demand than there is supply, then investors would usually identify this gap and meet the demand. So there might be a short term where there is a gap between the demand and the supply, but you would expect investors, because it's a free market, that investors would come in, identify the opportunity and say, oh, well, we can actually get some good returns on our money because there's a lot of demand. Let's build some properties and let's sell it. So I would expect a gap like this to not exist for very long. And that's why I'm not sure whether this kind of growth is a long-term, would be, continue in the long term, or almost close to 10% per year growth in the value of the property. But that, that's just got like kind of my side opinion on this. If we just take this as at face value, and then we look at the total return on this property, the rental yield is 6%, the capital growth is 9.5%. That gives us 15.5% per year as a return. And that is a little bit higher than the long-term average of the global stock market in Rand, which has been 14.5% since 1995. So it's a little bit higher than that. But of course, we're looking at short-term data. They bought the property in 2023, and now, this is only 2 years later. We don't really know whether this kind of capital growth on this property will continue over the next 10 or 20 years. And in my personal opinion, I think probably not, just as I explained before. And the last thing that I wanted to mention is when you are in a market where property prices are increasing hectically, then at some point investors also want a yield of their money, as in they would expect a rental income. And because you can't fully only rely on the capital growth element, just because it's usually not a very long-term thing, especially if it's an outlier growth rate, like I said before, you would expect someone to come in and fill that gap in the market. So when the value of the property becomes so high, but you can't really rent it out for that big amount because the renters can literally not afford to pay that kind of rent, then and they also cannot afford to buy those kind of properties. That also it has an impact on the property value, because all of a sudden, if the property prices become too high, then you're removing certain people as potential buyers because they cannot afford it. And also you are removing certain potential renters because they cannot afford. I mean, to make it a worthwhile property for the investor, you also need to get good rent based on the value of the property. Otherwise, you can just sell it and do something else with your money. So, those are just side comments that I would like to make on the value of this property. Is that if value skyrockets, then there usually becomes a mismatch between the rental yield and the value of the property, because all of a sudden you're not getting enough income to justify having such a high value property. And in my mind, I would then sell it to take that money, the value of the property, take that money and take it somewhere else where I can probably get a better return on my money. So this is actually not a bad return. If we take this at face value, I would just always want to question, is this sustainable for the next 10 or 20 years? Okay. But then the second example was an extra house that they built on their property, and it is a 2.5 hectare property. The original house, 650,000 with a original house on. This is what it cost them. And then they built an extra house on the property for 550,000, which they rent out for 7,500. The entire property, meaning the entire, all the land with the two properties on, could reasonably sell for 2.2 million. And they bought this in 2008. And he says, sorry, it's a bit complicated. So it is a little bit complicated, but I actually like examples like this where people take their primary residence and they add some value to it, which also generates income to them. Because primary residence, if you've seen from my other videos, is, in my opinion, a lifestyle asset. So it's not an investment, and many people treat it incorrectly. It's actually a lifestyle decision that you make to spend a lot of money on, or to spend actually just money on your primary residence, especially because people tend to overspend money or over-allocate cash flows towards their primary residence if they buy a property. But what I love is when people say, okay, but now I'm actually going to, add either a garden flat, or I'm going to build something, or I'm going to rent it out, and I'm going to make some extra cash from that, so that my primary residence is not something that's just basically an opportunity cost. I'm getting income from it too. And in this case, this is exactly what he did. He built an extra property, which is renting out for 7,500 a month. And I also spoke to someone else 2 weeks ago that said they did something similar at their property, and he did some retirement calculations, and he realized he won't have enough money to retire, so he desperately needed to earn extra income. He built something on his property that he's already living in, or the land that he's already living on, and he's now renting that out, which I think is a great way to earn some additional income. And the reason is because I don't always want to just look at property investments or investments in general just from a money-making return, just from a numbers point of view. Sometimes we also want to consider the lifestyle or the return on life behind decisions. And if you're already living on a property, I would assume that the return on life on that property is quite good for you, because it's close to schools. If you have kids, it's close to your friends. You have your community around you. It might be already close to your job, and you've probably turned it into something that you love. Perhaps you've added a swimming pool or a nice braai area, or whatever you've done is so. Just there's also a lot of sentimental attachment if you've kind of lived in this property and made it yours. So when you can, I wouldn't like it. It has to be really bad, or you have to really overspend or over allocated your net worth to a property for me to say, no, you should sell that. Rather sell that because you need to start investing for retirement. In most cases, I like a solution like this, where you are enjoying your property, but you're also getting some income from it. So also the chances of you actually selling this is quite slim. I've seen people are super attached, very sentimental about their primary residence or the houses that they live in. It's not so easy to convince them that they should sell it. So personally, I'm not very attached to property because I've rented we've lived in so many cities and countries that I'm so used to renting. I don't have this personal attachment yet. Maybe it changes. Definitely changes once you start having kids, because you want to be close to a school, close to, you want to settle in your community. So we probably won't be moving around as much in the future now that we have our son. Okay, anyway, now I'm getting sidetracked. So my bias would always be to say, no, this is not a good idea, sell property because I've just seen too many examples of where it does not look good. But I obviously still want to be objective and want to look at the numbers. So if I run this, how I am analyzing this scenario is saying, okay, let's assume that you can actually divide this property into the one side you have your house, and the other side you have the other house that you've built on your property. And he said the total value is now 2.2 million. So I'm assuming the current value for the half that is rented out is 1.1 million. And the income from it is 90,000 rental income, 6,000 a year on 90,000 a year on rental income, 6,000 a year on expenses, and 5,000 on maintenance. So that is 78,000 after costs. And again, I'm assuming a 35% income tax applied to that, which is around 27,000, and that brings us to 51,000 rental income after tax. So the yield on the value, that means the return that we're getting on the amount of the value of the property, the return compared to the amount of the value, is 4.6%. And then, of course, I had to make some assumptions on the capital growth. It's not as straightforward, because it was a property, a piece of land that he bought, and I'm assuming that you can divide it. I'm not sure if that would be possible, but he paid 650k for the land, for the property 2 years ago, and then he bought something for 550k. He bought the house, so the cost is 875,000, and the cost in 2008 is the cost in 2008 is 875, and then the current value is 1.1. So this is a very rough rule of thumb assumption that I make. I'm sure that this is probably not something that you should read too much into, but then the growth would be on this specific imaginary piece of land and property would be close to 1.5% per year, which is obviously not a great growth rate. Even if it was double that, let's say 3% per year, which I think is close to the average property price increase in the Limpopo province, actually, is 6% based on these numbers. But even if we add 1.5% to double the capital growth, then that is 7.5%. So on a 6% return, total return based on rental yield and capital growth, that is just keeping up with inflation in South Africa, and personally not an asset that I would be happy about holding at all. Also, if we just consider the rand-dollar depreciation over the last 20 years, then this asset did just held its value in a dollar term way, and that is assuming that all of the rental income that you've received you were able to invest too, so that can also grow annually. So this one, again, if you just purely look at the numbers, I would probably say not a great investment, but realistically, you're probably not going to sell that. The return on life on this investment, as in it's your primary residence, is probably great. And I would say it could have been worse. That's probably what I would say, because if you did not build this, you would not have gotten any income from this property at all, because you would just have lived on it. So yeah, that's my 2 cents on that. I think 2 really important things to remember with property investments is that many people forget that returns are taxed. If you make returns on property, it's taxed as income, and income is taxed at the highest tax rates. Capital gains is taxed much more favorably, and dividends tax is also taxed at a lower rate. But income tax is really what you almost want to stay away from. If you're getting income every year in your bank account, that's really being taxed at potentially your highest marginal tax rate if you are holding these assets in your personal capacity. So many people forget that returns, you might do your back of the envelope calculation, but then you forget to think about the rental income that you're getting is actually getting taxed. Then a lot of people tell me, but yes, I don't have any income because my interest, I pay a lot of interest to the bank. But then I also want to actually ask you, are you making any profits? Is that property actually cash flow positive for you? If you're not, then the property is not cash flow positive, you're not making any income, you're not paying tax on it. So then it's probably also not a good asset. When you hold property investments, it is so crucial for wealth building purposes to reinvest cash flows. So if you make money, and you should be making positive cash flows to reinvest in order for you to take advantage of compounding. Compounding only happens when you actually have growth and the cash flows that you generate from your assets is you're able to reinvest that. So if you're, first of all, just sitting on the cash, you're making a rental income, you're making profits on your property, but you're not reinvesting it somewhere, then that is not going to help you compound your wealth over the long term. So that's really, really something that I want you to remember if you have property investments. Okay, now that was a long one. Let's move on. Let's move to the next one. Lives in Doha, and she's 47 years old, and she says, "Good day, Carla. We're a South African family living in Doha, and we are not tax residents in South Africa. We are able to save a significant amount each month, but we are unsure what to do with it. We would like to find an international brokerage where we can invest money directly ourselves. Could you suggest online platforms? And what are the tax implications if we return to South Africa when we retire?" So this tax question is quite a popular one that I get from expats. And if you earn money offshore as an expat, I would definitely say keep it offshore, because you are offshore, your money is already outside the country or outside South Africa, invested there. Interactive Brokers is the brokerage platform that I use, and you can they serve many countries. It's international. It's one of the biggest brokerages in the world, and you can open an account with them from Qatar. And if you open an account there, you're able to buy your own ETFs. And if you're not sure how to analyze ETFs or how to think about your portfolio, then you can definitely do my investing course, because I cover all of that in detail. It's really to empower you to be a DIY investor, and it's very, very informative. The other thing is also what I see with a lot of expats is they hold cash, and that's definitely not the right thing to do. If you are holding money and you are a long-term, you want to build wealth over the long term, it is a no-brainer for you to start investing in the stock market. And I really hope that I've got lots of videos that you can watch around this. I really hope that I can convince you in my other videos, because I'm not going to spend too much time on that during this episode. So please invest your money, don't hold it in cash, because that's not in the long term where you're going to get the growth or build the wealth. And then also when you return to South Africa, so now they're not tax residents, and that means when you're outside SA and you're living in Doha, you fall under the tax rules of that jurisdiction. So your money is tax-free at the moment, and all of your investments and the growth and the dividends that you get will be tax-free. So you don't have any tax obligations on that in South Africa. When you move back to South Africa in the future, then you, within 21 days, if I remember correctly, it's either 12 or 21 days, I think it's 21, you need to inform SARS of your change of intention and that you're basically back in South Africa and you're now a tax resident again. Then your the base cost of your assets or your investments would be the value of when you moved back to South Africa. So I would then look at, when you come back, look at the investments that you have or the assets that you have, and keep record, or even, perhaps talk to a tax specialist about this, but keep on record what the value of the assets were when you moved back. So only when you come back to SA, your new base cost of your assets. So it's basically a way to say, let's say as if you bought those assets on the day that you moved back, what was the value? So the value between you buying it now and let's say you're coming back in 5 years' time, that entire growth will not be taxable in South Africa. It's only the day that you come back, that will be the day where the new value of your assets is determined. And then from that point going forward, the growth and the dividends will become taxable on your stock market investments in South Africa. Okay, but of course that is not tax advice. That's just the way that I've researched this topic, but if you need to talk to a tax specialist on this. Okay, perfect. 2 more interesting questions. The next one is from an accountant in the Netherlands, 26 years old. And the question is, your stock analysis was very intriguing and used figures to consider US dollar appreciating against the rand. However, if we invest in the S&P 500 in euros, is it better to invest in US dollar or euro in the S&P 500? And also knowing that I earn in euros. So this is a very common question, and that I get about returns in different currencies. So you have to realize with an S&P 500 ETF, the underlying assets is US dollar assets, because you are investing in an index you're investing in an ETF that tracks an index that holds the 500 biggest companies in the US, and those returns are in dollar. So whatever the ETF is denominated in euro in this case, you're still holding dollar assets. The returns are in dollars, the capital, the shares, those shares that you're holding are quoted in dollar terms. But it is really just, in a way, packaged to you in an ETF, which is converted to euro. So your underlying assets are still the same assets, whether you're buying it in South Africa, in ETF, in South Africa, in ETF, in the Netherlands, or in Ireland. The underlying assets are still the same. It's really just converted and reported to you in a different currency. So what is important in this case is not to buy a hedged ETF, because hedged ETFs can be very expensive. They have a lot of fees built in order to keep that hedge. And the second thing is a US dollar ETF, which is based in the US, can expose you to CITES tax depending on your tax, your current tax jurisdiction, but also the future tax jurisdiction where you might be when you pass away one day. So you don't want to be exposed to US CITES tax. The next thing that is important is to consider that the total expense ratio, or the ongoing fees, the OCF is usually called in the European ETFs, of the ETF. You can find that on the fact sheets or the minimum disclosure document, or it's also called the key information documents. So you can find the fees there, but usually the big ones from Vanguard, iShares have low fees. Then the last thing is you are earning in euros. So buying an euro ETF with low fees makes sense, in my opinion. The only thing is, of course, to make sure that it's not a hedged one and that the fees are not too high. Okay, that is what I would personally consider. The next question is from a teacher in Pretoria. And I like this question because it is, I think, one that a lot of people encounter and wonder about. She says that she's got 200,000 in her savings account and she's got no debt, a few investments, and she's maxed out her tax-free savings account. She's very stingy. She's got no risk appetite, and she works hard for her money and she doesn't want to gamble with it. Her friends are investing in crypto arbitrage. They don't own a house, and then she wants my view on this. Should she do the same? So this is quite a loaded question, and I like it. I like that you're thinking like this and you're asking the right questions. So the first thing that I want to say is, you mentioned that you've got a tax-free savings account that's maxed out. One, is that tax-free savings account, is the money invested? Because many people think that they max out their tax-free savings account, and now that they've done the right thing, but they just hold it in an account that earns interest. Many people make this mistake. Tax-free savings account should actually be tax-free investing account. You can invest that money. Please don't just save it. So you can invest it in, for example, an MSCI World ETF, which gives you exposure to the global stock market. Get a low-cost ETF like that, and don't invest your TFSA in high-fee products, and please don't just hold it in cash. Those are the two big mistakes that you can make. The second thing is, you are so young. If you're 25 years old, you can start investing smartly. This is like the most valuable, that your money will ever be. I actually did a little bit of a projection to give you an idea of that. I really hope that you can start investing and realize that investing is not gambling. Like, don't pick stocks, don't go to a casino, don't buy crypto meme coins. That's not what you should be doing. Okay, but let me just show you this tell you about this calculation first. So if you invest 200,000 and we're assuming a 14% return on the MSCI World, which has been the average annual return over the last 30 years in rand terms, then over a 10-year period, that could mean 740,000. If we assume, of course, there are no guarantees about what the return will be. But if your timeline is long enough, it's a no-brainer for you to invest in the stock market. But we can't say, oh, you're definitely going to get 14% return. It could be a little bit lower, but it also could potentially be higher. The volatility is really what you are rewarded for. The fact that you're taking risk is also why you're expecting returns. It's completely different if you take no risk and you sit with your money in the bank. But the bank is using the money then to make money for themselves. Over 10 years, 200K invested at this assumed 14% return in rand could mean 740,000 in 10 years, 2.7 million in 20 years, and 10.1 million in 30 years. And then if we take it to 40 years, as in you're investing from the age of 25 to the age of 65, so you've got a 40-year timeline, that could mean 37.7 million. So the difference between starting now at the age of 25 versus waiting 10 years and starting at the age of 35, that's actually a difference of 27 million, which is crazy, because how compounding works is that it really goes up exponentially. So it increases, but then the growth is exponential. And you literally, after 30 years, it kicks in like crazy. So if you can have a timeline of longer than 30 years, I know many people don't, including, well, maybe I have a timeline of longer than 30 years, but many people, only start at 45 or 25 years old. Please start being smart, because you've got a 40-year timeline until the age of 65 where you potentially want to retire. And an extra 10 years in your investing timeline can literally mean 27 million extra for you. So 37 million in 40 years' time is similar to 3.6 million in today's terms. I always want to put this like extra information in there, because people think about 37.7 million, they're like, oh my word, that's so much money. But you have to remember inflation, and also that the value of 37 million in 40 years is not the same as 37 in today's terms, because inflation erodes value in a way. So how we want to think about that is, if we want to project, okay, but what could it potentially be worth in today's terms? Let's assume like a 6% inflation annually going forward, which is quite high. That could be similar to 3.6 million in today's terms. Okay, I hope that makes sense. It's still a significant chunk of money, and you should please invest smartly, a global stock market ETF. So not paying high fees, not picking stocks, and also not holding the money just in interest, because that's really not where you're going to get the most growth in the long term. Okay, I hope that makes sense. Then the last thing I wanted to say on this is on crypto arbitrage. So personally, I don't do crypto arbitrage, and I know that there are some people that are big fans of it, and you could put some, potentially put some money towards that. The crypto arbitrage really means that, or it really exists because there is some friction in the market, and you could sell crypto for a price higher in one place than what you're buying it in another place. So that's really a basic concept behind this. Is imagine you can buy a Louis Vuitton handbag in the US for $500, and then in South Africa, because it's not available in South Africa, you can buy the handbag there, fly to South Africa, and then sell it here for $600. So the thing, so this is not an easy way to explain this, is that when people start realizing, oh wow, there is a gap here, then everyone's gonna start flying to the US, buy Louis Vuitton handbags, and come to South Africa and sell it at a 20% profit, because they, say, oh wow, this is a quick and easy way to make some money. There is a gap, there is an arbitrage opportunity. The thing with arbitrage is that over time it decreases, because more and more people start taking advantage of the opportunity. But because there is some friction in the crypto market compared to South African exchanges and US exchanges, so you can literally buy crypto somewhere, sell it for a little bit of a profit somewhere else. There is very little risk in this, but there is one big risk, of course, is that the crypto that you buy, it's held on certain exchanges, and although the crypto market is maturing, and we won't have as many exchanges going bankrupt in future. It has happened in the past where people sit on crypto that is on an exchange in a moment. Of course, with crypto arbitrage, you actually don't hold it for very long on certain exchanges, because the idea is that you buy it somewhere, it's held on an exchange, you move it to a different one, and you sell it again. But you are still exposed to a certain period of time to an exchange. And if something happens in that moment, then it can not turn out that great for you. But that being said, perhaps it is worth something to consider. Personally, I don't do this just because I prefer to have my money in long-term ETFs where it's completely passive for me. And I, but of course, if you have any other insights on this, on crypto arbitrage, any of the listeners that you want to add to my comments, happy to receive your comments to see, if we can learn more, or if we can actually educate people more on this topic. And also, just the last point is, if you're wondering whether you should start investing, is you need to really stop moving away from the mindset of, I want to hold this money in a bank account because I know it's safe. And this is really what keeps people poor. Is not realizing that you need to educate yourself on this, to take some risk, to invest in the stock market. But you're taking broad risk. You're really just including all of the stocks in the global stock market in an ETF, not all of them, 85% of the stocks in the global stock market in an ETF, and you're just tracking the global stock market. You're not exposing yourself to like one stock that is like Steinhoff, or you're not overexposing yourself to anything. You're really taking diversified risk, if I can call it that. And especially if you're that young, it's so important to do. But you also need to learn to deal with volatility if you want to be a stock market investor, because the long-term trend of the stock market is growth and dividends and positive over the long term. But there are years where it will go down, and you need to be able to deal with that. But that's the best thing that you can do for yourself, is to learn how to tolerate that and how to deal with those emotions and how to be consistent and stay invested in the stock market. And the last thing I want to say on this is I've never met an investor with zero risk appetite that's smart. Anyone that's educated enough and understands it enough will not have zero risk appetite, because they understand that if you take a diversified approach, if your timeline is long enough, then you are going to take risk in the stock market, because that is where you're going to get the returns in the long term. You will not get anyone that is really smart, educated stock market investors that just prefer to stay on cash over a long period and just hold money in a savings account. Okay, I hope that is helpful, and I, of course, would very much welcome any other questions that you want to submit. And we have also started adding these episodes on podcasts on Spotify and on Apple. So we are including all the links to submit your questions. Very looking forward to seeing your questions, and also then speaking to you in the next episode.